What's our first question, JD?
Well, remember,
Oh yeah, where to
send in questions when you do get them. Either give us a call or send us an email. I have cash sitting on the sidelines. Now the market is down. Do you recommend cash to reinvest in the markets? Sounds like a market timing question. So the real thing is, and this is very broad advice. It's obviously specific to each situation. If you need the cash to pay your mortgage this month, there's no good place to put it. That's a week away. You've got to be ready for that. But if this is long-term money that is specifically designed to be allocated for retirement purposes, or it's new investable money, and maybe you want to work it in over time. But the real question you have to ask yourself is, the next 20 years, if you're looking at long-term investments, what's usually the best place to be? And it's usually very aggressive things, private equity or equities in general. Those are some of the most aggressive things you do. Those are probably going to give you the highest returns over a 20-year period. That's what history has repeatedly shown us. And of course, history is no guarantee of future results. But if that's the case, buying today, if the market's 5% higher, and next week on a 20-year basis, it's still extremely small. It's really, we get caught up in the day to day, and we make market timing look easy because back in July I said we talked about the market coming down and kind of how it was going to happen, and it seems like that's proceeded.
Now it's reversing.
It started the next day, but now it's reversing. So no, it's one of those things where it's incredibly difficult to time the market. If this is really long-term allocated money, the question is, what else do you own as part of your diversification strategy that you should be putting into next? And I just spent earlier this week, I spent the last 2 days at a seminar going to Blackstone, talking about their platform and their availability offerings and some of the diversification they bring to the table between private credit, private real estate, private equity. And it's not right for everybody. It's not right in every situation. But that's one of the questions: is what else can you look at other than equities? And of course, why was that money on the sidelines in the first place?
And it just add at the end here, the Federal Reserve did lower interest rates 50 basis points yesterday. So I heard some the other day on CNBC say, it was easy to buy CDs and chill and hang out there.
Treasury bills and chill.
Yeah. So that's not going to be the case. The CD rates, money market rates are all going to decline over the next 6 to 12 months. So it's time to put the money into something that is longer term, and that could be corporate bonds, could be municipal bonds. I mean, it depends on your situation, but again, if it's long-term money, it should be in long-term investments.
You talked in the past about overconcentration risks in the indexes. Are you still concerned about it?
Yes, even with the recent correction in the market, we did have, everybody's heard the Magnificent 7 and how they were outperforming. They did correct back, but it's still a highly overconcentrated market. It took it down from the heights. The top 10, I think, were 38% of the index, and they came down to 35, but it's still very concentrated. And there's some issues that have come up recently that I've read about that are important. Mutual funds, pension plans, a lot of investment products have rules on how much you can own. And concentration risk, there are rules around what you can do there. For example, mutual funds, which I used to run, you can't buy more than 5% of one company. And you can't have more than, if you have companies that you own more than 5% in them, they can't add up to more than 25% of your portfolio. Well, because of the craziness in the big 7 or big 10 stocks, many mutual funds, many pension funds are now basically breaking those covenants, as we call them, or requirement.
Yeah. So I guess the question was, are we concerned? The answer is, we've been concerned, and now everyone else is concerned too.
Yeah, but you're right. This is government regulation. It moves slow. They're going to get to it. You're going to read a lot about it sort of after the fact. But next question, what did the Fed's decision mean for the markets? If you didn't hear, the Federal Reserve lowered rates by 50 basis points, or 0.5%. They've started the cycle of lowering rates. This is overall good news. They're done raising rates. And the market was kind of expecting 25 basis points or 50. They did 50, but John's going to talk about what that means for the market.
Yeah, it was very odd because usually when the Fed's ready to lower or raise rates, you have a pretty good idea of what they're going to do ahead of time. And this was one of those cases where the market really hadn't decided about, and it depends on when you exactly you look, but it was almost a 50-50 chance that it was going to be 50% or 25 basis points. And for the first time since, I can't remember what it was, I think it was like 2005, one of the Fed governors actually dissented with the overall decision and wanted us to go with 25 basis points. So it was a contentious decision, and that's unusual for the Fed. The Fed prides itself on being very transparent. What did come out of it is that the Fed seemed to be very dovish. That's part of the reason the market's reacting very positively on Thursday. But initially when it came out, the market responded very positively, and throughout Powell speaking, it sort of lost all that momentum and ended up negative for the day. So what does this mean for the long term? Remember, interest rates to really affect economic growth take somewhere between 12 and 18 months to take full effect. So what does it mean tomorrow? It means, well, today it means CD rates are probably lower because that's the quickest and most direct effect. What does it mean long term for the economy? It means that borrowing is going to get cheaper, but that doesn't happen overnight. And by the way, mortgage rates are not going to drop off a cliff. The spreads are going to stay relatively high because they're tied to the 10-year Treasury.
It didn't move that much, yeah.
Right. But what is probably more important from the Fed is we know that they're going to start this cycle of lowering. How quickly? I think people are expecting another 50 basis points between now and the end of the year. But who knows if that's exactly what's going to happen. Remember, this is still a group of humans. This isn't a perfect system. It's not perfectly predictable. But if we're expecting another 50 basis points or a total of 100 between now and the end of the year, we also want to be very clear. This does not mean we march back down to zero. We're probably not going back down to zero rates. Inflation seems to be pretty well in hand. The stickiest part of it has been shelter, which seems to be moderating in the past few months. But having a trailing PCE of a little over 2.5 is kind of exactly what the Fed wanted to see. So now they're more worried about jobs, and I think that's their primary concern is that they don't want to see the job market get out of control. So what does this mean for the market? What does it mean for the economy? What does it mean for the market are kind of two different questions. From an economic standpoint, it's an inflection point. We were very adamant when the Fed stopped raising rates. That was a very important period. And we said at the time, we thought the market was going to rise after that stop.
That's over a year ago.
Yeah, and then, of course, that's pretty much exactly what happened. Part of the reason we were convinced of that is because historically that's what you're going to see, and because it means that you're going to see slower economic growth in the future. It meant that growth was too hot, which it was. And now we should be expecting lower economic growth in the future. And I know people have talked about how we've had slower growth than we did just a little while ago, but typically this is the start of that slower growth period. So we're hesitant to start using the R word or recession yet. That we don't quite see that in the cards, but this is usually what predicts it when you see hard landings. Now, are we still in a soft landing scenario? Our estimates are that we probably are, and we'll keep updating our information as that changes. But why is that important? Well, there's not been that many soft landings. I mean, what is it? It's there's 1996, 1997, 1960.
Yeah,
and then there's a third one.
I think there was one in the 80s.
Yeah, but it's not very common. And typically when this happens, one of the things that was pointed out to me recently is when you do see a soft landing that's successful, typically the Fed is raising rates about a year after their first cut, which, I don't think anybody has on the table right now. So what exactly this looks like, it means that the economic growth figures are down, which is great because it means that we know kind of what the damage is going to look like. It means we got a clearer picture as to what we think things are going to be. When that's the case, the market's usually much more positive.
Yeah, just a short, the Federal Reserve 2 years ago was worried about inflation out of control. And they have two jobs. There is price stability is their job, and full employment is their job. Those are their mandates. That's all they look at. They don't care about anything else, and they don't care about elections. But the fact was prices were out of control. They had to get prices down. What they told us a year ago is they thought they did enough to do that. A year later, yesterday, they said they pretty much feel that inflation fight has worked. So their other mandate is full employment. They want to lower rates so we don't end up with high unemployment. And they're trying to catch it early, and that's the right thing to do. Overall, this is all, overall good news for the market.
Yeah, it means cap rates are lower. It means that borrowing rates are lower. It's overall good for business.
But what you did say is very important. Is we're not going back to 2 or 3% mortgage rates. That we're not going back to zero.
If we are, we don't think that's in the next 12 months.
Well, that's not a good thing at all. That means we do have a hard recession. But the fact is, we're back to normalized interest rates. Even the Fed's predictions are going to take the rates from 5.25, which yesterday it took down to about 2.75 over the next 2 years. So
yeah.
that's back like the normal rates we're used to in the past.
All right. Well, again, if you have questions or follow-ups, send us those questions. The email address is still the same. We do have an upcoming talk on cybersecurity. We've got a couple of different things on cybersecurity. So I'll be talking to Paul Riedel, who's a good friend of mine at River Run, on Thursday, September 26th. So next week. It's amazing how time flies.
Goes fast, yeah.
And let's face it, it's not a matter of if, it's when now. So being more and more vigilant about these things is more and more powerful. Additionally, Frostbite, our book of the.
You just finished it, right?
Yeah, I finished it a few weeks ago. It was really good. It was quite good. I know we were talking about apples on the last podcast, talking about how they're pink on the inside and why you can't get them. It's because of refrigeration. But refrigeration is, it was voted the most important change to humanity at one point. Seems wild. Refrigeration, it seems so normal and commonplace. There's not a store you don't walk into that doesn't have a small mini fridge, or we've got one here, and cold drinks. That's all relatively new.
Yeah, but the book makes a great point. It is probably one of the most important scientific discoveries in the last 500 years. 150 years, we didn't have refrigeration. So if you grew meat in Argentina, you couldn't ship it around the world. They had an abundance, too much meat. New Zealand had too much meat. Western United States had too much meat, and they couldn't eat it, or it goes to rot. Once we got refrigeration, we were able to move around the country. So we got the ability to move protein and calories all over the world because of refrigeration, and keep it around longer so it wouldn't spoil. It's made a huge difference in everyone's lives, and it's hard to imagine if we didn't have it.
And probably the thing I think was most exciting at the end of the book was that refrigeration has brought a lot of modern conveniences to our lives. But what's next is we're going to start choosing foods and flavors less so for their ability to be refrigerated, because we're getting so much better at it that we're going to be able to pick more and more things around the idea of flavor and freshness. And so, the outlook for better food supply, more efficient food supply keeps improving.
Yeah, everybody my age group remembers tomatoes when they used to taste good, and then it developed tomatoes that could be picked by machine. And for years, we've all complained tomatoes aren't like they used to be. We are going to get better at that.
Yep.
All of them are going to get better. You're right. We're going to have better flavored foods again. But it's more progress. The book was fun. It's certainly worth the read.
Yeah, absolutely. With that, thanks for joining us today, and we're going to sign out. Any final parting thoughts?
No, enjoy the weather while it's here. It's almost fall. It's still 80 degrees out today, which is great. And besides that, go Pack, go.
Go Pack, go. Thanks, everybody.